Hello, hello, friends. Welcome to the first Investors Gate Market Taker series, where we get into the most important macro forces driving markets and then hit the micro side of things with a deep dive into the charts. With that said, let's get into it.
My man.
All right. Oh, we'll get to that. Don't worry. So I want to start off with this story. The central banks recently have pretty much done away with forward guidance and switched to a data-dependent approach as economic growth slows. So the shift in rhetoric we've seen from multiple central banks, including the US Fed,
Come on, man.
the ECB, and Australia, though it's really something every central bank is having to come to terms with, they all have to at least act like they're serious about fighting inflation. But they also have to be aware of the potential recession the globe is headed toward and how their policy could be making that worse. So I guess put another way, they're just trying to remain nimble so they can better adapt to the changing data.
Right.
So every central bank is pretty much stuck between a rock and a hard place, with the rock being inflation and the hard place being the recession on the horizon. And with all that uncertainty in the air right now, that could translate to more volatility in markets who no longer have any guidance to latch onto.
Little bitch.
So just to summarize, forward guidance is pretty much out the window, so central banks can adapt to the changing economic landscape because a lot is happening right now, and trying to balance the inflation threat and the recession threat or economic growth slowdown threat is challenging, and the Fed or all these central banks don't necessarily want to commit themselves to any particular policy because then they have to backtrack, and that ruins their credibility. Okay, let's transition to the next slide. So the market right now is kind of seeing the Fed as turning dovish, which in turn led to rates going lower, which in turn leads USD JPY to fall. And let me break this down piece by piece. So why did the market think Powell was dovish? I'm glad you asked. So with central banks essentially getting rid of forward guidance, the market saw that as a sign that they are getting closer to pivoting, because it was maybe implicitly acknowledging that growth was slowing and monetary policy might slow with it. And if the Fed or any other central bank slowed down their rate hiking to accommodate the slower economy, that would mean bond yields could have peaked or reached their terminal rate in this cycle. So if investors think that bond yields are at or near their high, they're going to start buying bonds to eventually ride future rate hikes all the way down.
That's what she said.
Because when interest rates get cut and yields go down, bond prices go up and investors make that motherfucking money. Unless they're shorting, then they lose that motherfucking money. But a dovish Fed gives the market a reason to front-run rate cuts and buy bonds. And a hawkish Fed gives the market a reason to front-run rate hikes and sell bonds. Got it?
Yep.
Now, how does this play into the dollar-yen? Well, because the Bank of Japan has pinned its yield at 25 basis points, the difference between its yield and the U.S. yield is entirely due to the movement in the U.S. Treasury. If U.S. yields go up, that spread widens. If U.S. yields go down, that spread narrows.
Totally.
This is important because Japanese investors who are starved for yield are drawn to treasuries the higher their yields go. If the U.S. pushes rates to 3% and the Japan yield is still 25 basis points, Japanese investors are going to want to sell yen and buy dollars. This concept is referred to as interest rate differentials and is arguably the biggest driver in foreign currency exchange rates. Investors want to park their money in the currency that will yield them the highest return. So if one currency's interest rates move higher relative to another's, it becomes more appealing to investors. And this is why we see such a strong correlation between the US 10-year yield and USD JPY.
Not crazy.
Okay, let's transition to the next slide. So here we see a graph of the yield curve, or what a healthy, flat, and unhealthy yield curve look like. But let me dive into this. So the US 10-year recently traded at parity with the US 3-month yield. And this is not the only part of the curve that's been inverting, but I wanted to point this out because the curve has been slowly inverting at lower and lower tenors.
Oh, hell no!
So in this graph, you can see a healthy or normal yield curve right here in blue, and the unhealthy inverted one, and then also a flat one. So what makes this normal? Well, if you look here at the beginning part on the left side of this graph, these are the shorter duration, shorter tenor treasuries or bonds, and then you have the belly of the curve, and then the longer duration like 10-year, 20-year, 30-year. So the shorter end would probably be like 3-month, 2-year, 1-year, and then obviously so on as you go down duration or up in duration. And there are a number of reasons that longer duration treasuries or yields should be higher. And I'll break it down. So you have opportunity cost, you have risk costs, and there's just like an intuitive concept that longer duration should pay you more because you are giving your money or loaning your money for a longer period of time. And that what comes with that is opportunity costs. You could invest your money in something else. If you invested in a 10-year treasury, you would be missing out on potentially 10 years of other opportunities to invest in different markets or assets. So that is one reason that you usually have a premium on longer duration versus shorter duration. If you're just parking your money in treasuries for 3 months, the likelihood of you missing something is much lower than if you parked it in 10 years. Another reason is the risk associated with longer duration assets. If you invest in a 30-year treasury, you have no idea what's going to happen 30 years down the road. There is so much uncertainty. There could be a war, there could be a default or currency collapse, a whole host of problems that happen. And you have to include that into a premium, presumably, to account for that risk that you'd be taking on as an investor. Take the example of Argentina. Argentina has their own 30-year treasuries, and they've defaulted on them 3 times.
Not crazy.
So investors were never compensated for that risk, regardless of how high those yields were. But that is one reason why you would expect in a normal yield curve to see lower tenor treasuries or bonds trading at lower yields or with lower yields than the higher yielding or higher duration treasuries. And then a flat curve would just be everything kind of trading at the same yield, which is probably more unhealthy than healthy, but not nearly as bad as an inversion. Because when you have an inverted curve, what that means is, exactly the opposite, that you are getting paid less to invest money longer. And take the United States for example, because that's what we're talking about here, the US 10-year and the US 3-month. I'm not 100% sure if they actually inverted. I know they did trade at parity because I was watching it live. I think they might have inverted by a few basis points. But why that is so substantial is because at a certain point, investors would have been paid more to give the United States money, because that's what you're doing when you buy a treasury. You're basically loaning them money. They would have been paid more to loan the government money for 3 months than they would if they loaned them money for 10 years. Just think about that. This is the sign of an unhealthy economy. And just for more context, this is not something unique to the yield curve. This has been happening all throughout the yield curve, and it's just extending to lower and lower tenors, the 3-month being the newest or latest victim. The 10-year and the 2-year have already inverted, and historically that has been the go-to sign of a recession in the future. When those invert, then a recession is likely on the horizon. And now we're seeing it at the 3-month. The yields have since retraced, but that is something we saw at one point, and that inversion happening at any stage is not a good thing. And one thing you can potentially take away from this is that the market is predicting the Fed will potentially pivot within 3 months. Just use that time frame for simplicity's sake. But if the yield on the 3-month is trading higher than the 10-year, the market is saying that the Fed is going to change its policy very soon because the 3-month or the shorter duration treasuries are much more heavily influenced by the Fed's policy, because regardless of what the market thinks, the Fed largely controls the short end of the curve. So if the 3-month treasury starts trading higher than the 10-year, that is the market sending a very powerful signal to the Fed. Both of them cannot be right. So is it the Fed or is it the market? We'll see. All right, let's transition to the next slide. So, Russia fears inflation and the energy crisis are weighing on the euro and European nations right now, and that has led bond spreads to widen dramatically, which is consistent with risk and uncertainty driving investors to safer assets. So, this graph right here is the spread between the German Bund and the Italian BTB or P. I forget what it is. Doesn't matter what the acronym is. The Italian bond. And that spread, as you can see, has been widening dramatically over the past few months. And right now it's trading at about a little over 200 basis points difference. And as that spread widens, what that tells us is that investors are getting nervous. They are seeing potential threats, risk, uncertainty, and fleeing to safer assets like German bonds. And the reason for this is because nations like Italy, Greece, Spain, Portugal, the PIGS acronyms, they are heavily indebted. So interest rate hikes affect them a lot more than a country like Germany or Austria or the Netherlands, who have healthier balance sheets and levels of debt.
Totally.
So with the ECB attempting to raise interest rates, which they realistically have to do if they want to come off as serious about inflation, and that's what the stronger economies like Germany want them to do because they can weather interest rate hikes better than the other countries, and but inflation is hurting them a lot. So they would rather slay inflation with higher interest rates and deal with whatever economic contraction or slowdown that may follow from that. Other nations like Italy, on the other hand, they are not really in a position to weather that kind of interest rate hike, and that could lead them to defaulting. So this is part of the risk-off mentality that has been going on in markets, part of the reason why investors have been fleeing to the dollar and why the dollar has been appreciating so dramatically relative to most other currencies, especially the euro. And I pointed out this specific chart because the spread between the German Bund and the Italian bond, or their two risk-free rates, is probably one of the best indications of the current state of the European economy. If that spread tightens, that means things are maybe looking a little bit better, at least temporarily in the interim. And if that spread continues to widen, that is a good sign that the market is seeing greater uncertainty, risk, potential default by Italy, or just broader economic turmoil that is leading investors to leave more indebted countries or speculative, unsustainable economies with these levels of debt and fleeing to safer assets, German bonds, dollars, whatever it may be. Got it?
Yep.
Okay, next slide. So, inflation-adjusted returns fall with risk-free rates falling as well. And then bonds become less attractive, and investors seek higher returns, which in turn leads to risk assets rallying. And the reason I wanted to bring this up was because bond yields recently fell, again, kind of in line with the dovish Fed. They're trying to front-run rate cuts, and so bond yields fall. And when that happens, especially amid all the inflation that we're seeing right now, investors need to find assets that will compensate them in some way, because if the risk-free rate goes down, investors have to chase yield, find yield somewhere else, and the risk assets are usually the best place to look. So here is a chart of basically the risk spectrum that every investor should be loosely familiar with. So at the bottom, you have money market or government treasuries, and these are the safest, not riskless, but seen as the least risky assets in the market, mostly because the government has an unlimited balance sheet and they can print as much money as they want to ensure that people get their money for whatever investment they are backing.
I'm really rich.
And then you have investment-grade corporate bonds, which is something like Microsoft or Apple, their bonds, and those are seen as the next least risky companies because they have boatloads of cash, very healthy balance sheets, and in general, the likelihood of their default is extremely low. a little bit more risky than government treasuries just because Apple, as much money as they don't have a printing press. Aww. But still a relatively safe investment. And then next we have blue chip large cap equities. So this could also be something like Apple or Microsoft. It's just instead of buying their bonds, you're buying their equity. It would also include maybe a lot of the S&P 500 companies, all the companies in the Dow Jones, or really just any of these high market capitalization companies. They would be roughly in the middle of this curve, as you can see, and up one tier on the spectrum of risk. And then we move over to small cap equities. This would maybe be stocks inside the Russell 2000, or really any just small, low capitalization company. And then you move to the very end where you have crypto and high beta tech or growth stocks. So crypto is generally seen as a liquidity sponge and a highly speculative asset. If there's more money, more liquidity entering the market, then crypto will go up. If liquidity is drying up, leaving the market, then crypto will go down. And it's kind of the same for high beta assets, which refers to just high volatility or volatility in excess of a benchmark index like the S&P 500. And a lot of the tech growth stocks that I'm talking about are high in a lot of debt. This would be like Cathie Wood stocks, all these high debt companies that maybe can't weather interest rate hikes, but they're viewed as more speculative and because they're in debt. They don't have maybe earnings, but bottom line, the highest end of the risk curve is crypto, high beta tech growth stocks, and as investors are not able to get as high of returns from the risk-free rate because of inflation-adjusted returns, they will seek returns in the more speculative assets. So when you see these transitions, something like crypto will move higher than all these other investments. And when investors go the opposite direction, say the risk-free rate rises and those assets become more appealing, it'll be the opposite. Something like crypto will be down the most, then small cap equities will be down just a little bit less, and so on and so forth. All right, got it?
Yep.
Okay, last slide right here. So right now, we are kind of in the middle of two competing camps, the inflationistas and the recessionistas, or price stability versus growth. And what I mean by this is kind of in line with the first slide about forward guidance. The first fight that the Fed and central banks were focusing on, or even the market was focusing on, was inflation. Inflation was too high. It was causing problems, a lot of economic distortions, and we needed to solve that. But now that the Fed is hiking rates and there are signs that the economy is slowing, we had 2 negative prints of GDP, and you can debate whether or not that is a recession. Doesn't really matter. It is what it is. 2 negative quarters of GDP is not a good sign. It definitely shows that economic growth is slowing down. And there are other signs like manufacturing slowing down and all sorts of things, inventory piling up. But there are signs now that economic growth is slowing and there is a potential for a recession, if not one at present. And so trying to battle these two things is really the story underlying most investment theses right now. Is inflation the biggest problem, or is recession the biggest problem? And those are the inflationistas, recessionistas. Which one do you think is the bigger problem that the Fed is going to have to focus more of their energy on? Are they going to have to keep fighting inflation and kind of put recession fears on the back burner? Or is the recession going to be strong enough that price stability is in some sense reinstated by squashing inflation? So just to reiterate, is the recession going to tackle inflation, or is inflation going to stay in the driver's seat and keep recession on the back burner? Not that they can't coexist, that's called stagflation, but the Fed is going to have to tackle inflation, and it's possible that a recession does their job for them. But that's not a guarantee, and so this is why they have to remain nimble.
Right.
All right, with all that out of the way, let's go ahead and transition to the charts. So we're going to kick things off with the US10-year and some of the other bond yields. I'm not going to spend too much time talking about them, but I thought I'd at least touch on the price action a little bit.
My man.
So like I said, this is the US10-year, and not too long ago we put in a high. Whoops, that's the wrong thing. We put in a high around 3.5%. And we've recently put in at least a short-term low of about 2.5% down here. And as you can see, it does look like we could be shifting direction. We had, let me get my marker tool out. We had these highs right here, and it looks like we broke those. So we've had this break of structure where we could be set to continue making these higher lows, because we had this low right here around 2.5 and another short-term low around 2.65, and now we're still headed higher, showing some strength. Could be pulling back a little bit, but we made this high in this break of structure, which leads me to believe the chance of a continuation in the formation of another higher low is very possible. So the level that I would be looking at for the 10-year is really anywhere in this general region, the 274 to 265 area. And you can tell we had this large green candle, kind of this imbalance that needs to be filled, particularly around the 2.7 level. So you kind of got a quasi-psych level as well. And what I might be expecting is, regardless of what happens, we already made the high, technically, this break of structure. So a pullback now would be fine if we pulled back into this zone, and we could be looking to bounce from there up all the way to this previous range, potentially, up in this area. If not, just to retest it. So price comes back into this range, and we could sit here for a little bit with some indecision, maybe some minor consolidation, and then I would like to see either a break below and formation of a lower high, wherever this high is, a lower high right around here, and then a drop, or the opposite, where we come into this new range, or this old range, I should say, form a bottom, maybe find some support around the range, doesn't matter if it dips below, and then we continue a little bit higher, break a new high. In which case, this being the new high relative to this previous one that dipped into or pushed into the previous range, wait for a pullback, because that would be the sign that this is an uptrend, and I'd be looking for, let me just draw that again for you. So this would be the high, this would be the next high, and then I'd be looking for a pullback that would hopefully make another higher low off of this level. So maybe somewhere around here, and then a continuation back up towards the top end of this range. Okay, so that is the 10-year. I'm not going to dive into the actual price action of the other ones, but I at least want to touch on them, like I said. So right here in the top right, you can see the US 10-year is now trading at 2.83. The US 3-month is trading at 2.527. Now, when I was preparing for this, I did see them touch at parity. We've seen a huge bounce since. So if I look at the 3-month, the 3-month has mostly been in a range, but the 10-year has seen a sizable move up in just the last few days. I mean, you can just tell this is a 4-hour chart, so just like a few days that we've seen this massive move up from 2.5, because this is a level around 2.5 where they were basically trading at parity with each other, and you had that potential inversion. Like I said, I don't know 100% if they traded or inverted. I think they did by a few basis points, but either way, parity is basically the same thing.
Totally.
And actually, real quick, I'll jump to the other bonds, just touch on this. So as you can see, the 3-month is hardly the only thing at risk of being inverted. The 6-month is trading at 3.07. So the 6-month is higher than the 10-year. So we've already seen an inversion of the curve all the way down up into the 6-month, and then we traded at parity, maybe even inverted us a little bit by a few basis points with the 3-month. And the Fed recently, somewhat recently, they talked about how they're not looking at the 2-year and 10-year because that isn't a reliable indicator.
Right.
They want to focus on the 3-month and 10-year, and when that inverts, then they'll be serious or look more seriously at potential recession concerns. And so that happening at trading at parity at the very least is definitely cause for concern, mostly because the Fed kind of committed to that loosely, that was the inversion that mattered to them.
Yep.
All right, so let's move on to, or go back to the the other bonds. So here's the spread you can see, or at least the two bonds, the German 10-year and the Italian 10-year. So German 10-year has actually gone up a lot today, 17%. I'll click on it, just see this price action. Now, when bond yields get closer to zero, the percentages can get a little crazy, even though it's not that actually that much, just because, say a bond yield is trading at like 5 basis points and it moves to 10 basis points. That's not really that big of a move, but it's 100%. So don't get too distracted by the fact that this is a 17% move. It's just because the German bond is trading pretty low. It was at like 80-something basis points, and now it's at 94. But as you can see, the Italian 10-year is at 300 basis points, and that spread is still a little over 200 basis points. Now, if we continue to see this narrow, that could be a sign, like I said, that the market is maybe they overshot the concern about an Italian debt crisis, and they're backing off a little bit. But I would assume that that yield continues to widen until the ECB maybe takes its foot off the brake, because they're trying to slow down the economy with rate hikes. But this is the spread to watch. And then we have the Japanese 10-year, which is supposed to be pinned at 25 basis points. Apparently the market is doing some of their work for them and keeping it down at 15, which is considerably lower. But, I mean, this chart has just been a mess. I think right here was absolutely ridiculous when you started seeing the market kind of fight the Bank of Japan and see how serious they were about it, which they were. I mean, they were willing to print, devalue the yen, at least in foreign exchange rates. And that's why we've seen the yen collapse. Well, not collapse, but, like 20% drawdown relative to the dollar. And it was funny. During after hours, you would see the Japanese yield just go up and down like this crazy volatility, just up and down.
That's what she said.
It was wild. But anyway, not going to focus too much on this. Just keep that in mind. It's a good metric to watch to see if it ever goes above 25 basis points, because you want to see the reaction of the Bank of Japan, because you never know. At some point, maybe they change their mind. They're like, okay, well, we're going to commit to 50 basis points or whatever it may be. All right, let's transition to the dollar index real quick. Okay, so we were in this range a while ago. This range from 103, or what is it, 103.4 to 105. And then we pushed out of that range to establish a new one all the way up to 109, and we've since retraced back into that previous range. So as you can see right here, we dipped below, and then we came right back up into the range we left, pushed above 105 with some strength, and we now formed a new higher low and made a higher high. So that has told me that this new range is the play, and we are making a low. We made a high, a higher low, and now a higher high. So I would be looking for another higher low, and the level that I'm seeing just right here is this, about 106 to 105.67. You can see this clear imbalance right here, this huge green candle. So I wouldn't be surprised to see price come back into this region. And if we were going to continue this uptrend, which I think is very possible, especially now that we've reclaimed this range that we left, pushed back into, we reclaimed it. So this is the level off of which I would think a new high would come from, in which case I might be targeting the midpoint or the range high up all the way at 109. I think longer term, the dollar probably will keep appreciating as the flight to less risky assets continues, or the flight to the, the safest, most liquid asset. I know it's hard to believe, but that generally is the dollar.
Totally.
So that is what I'd be looking at for DXY. Obviously, if we break below this low around 105.6, then that would be a breaker structure in my mind, and it's also now then be trading below that range. So I think looking for, let me clean this up real quick. So say we go from here, we break below this level, then I might be looking for sells on some sort of retracement into supply anywhere in this region. I would tread with caution though, because if we are retracing and then we get back above this range high, you never know what's going to happen. This could just be part of consolidation while the market figures it out, and then the ultimate impulse up or down is decided. But ideally, I would want to see it hold this level around 105.6, pull back into demand, and then continue this uptrend back ultimately to the range high of 109. All right. Got it? Transitioning. So I'm going to touch on these currencies just real briefly because I did a video earlier today about Forex currencies and I went through all this. I don't really want to go over it again. If you want to check it out, feel free. Some deeper analysis. But we recently traded at parity with the dollar around this $1 range. Obviously, 0.99 dipped below it even. And then we had this strong impulse back into this range we're trading right now. So we're mostly range bound. I would love to see some sort of deviation inside or outside of the range. I don't generally like to trade within the ranges. Obviously, if you get on lower time frames, you can have good risk to reward there. But I like to trade outside of ranges. I think the risk to reward is better. I do have a short bearish bias on the euro longer term, just because relative to the dollar especially, there are a lot of headwinds. I mean, dealing with the energy crisis. Their inflation is really just as bad, but it's still definitely a little different just because it's more, well, their energy crisis is much more real, and they're having to contend with the Russia war much more seriously than the Americas, or the America, than America is. I don't know why I said the Americas. You're South America too. So anyway, moving on. So I want to see some type of deviation above this range. I would love to see some strength in the euro short term, to be honest. That way I could get in on a short at a better level, because I don't really like this level. I don't think it's as reliable. But eventually I do think the euro probably will be headed down lower to at the very least retest parity, if not go below it. Especially if this dollar wrecking ball continues and the Fed continues to be a little bit more hawkish in their fight against inflation. Because if interest rates keep going up, the dollar is probably always also going to appreciate. I think the Fed has a lot more room to raise interest rates than the ECB. The ECB raised 50 basis points and immediately, at the same time, implemented their anti-fragmentation policy, where they're basically saying they're going to engage in this kind of form of QE to backstop bonds, or like the pigs nations. Italy. Sorry, Italy.
And we say bye-bye.
But yeah, so I think there's just more appetite for the United States to raise interest rates, and that interest rate differential will presumably lead to the dollar appreciating relative to the euro, and then you have all the other factors that I mentioned, like the energy crisis and Russian war. All right, so that's a basic framework for Euro USD. Let's quickly go over USD JPY, dollar yen. So actually, maybe I should touch on the correlation that I was talking about earlier between the dollar and the US 10-year. It's right here. Beautiful. Whoops. What am I doing? Okay, so as you can see, actually let me switch this to the line chart. I think I did the wrong scale.
You're a fucking idiot.
Is this the right one? That doesn't seem right. Maybe I did do the right one. Don't worry, guys. We're having a good time. We'll figure this out. Okay. Well, anyway, you can see that this is really, really correlated. And I'm not going to get back into it. I touched on it plenty in the earlier part of this video. But you can see they're strongly correlated, and that's because the yield for Japan is pinned. And so every time the yields in the United States rise or go lower, then the Japanese investors kind of follow suit. But yeah, just wanted to point that out because the chart I was using was a little bit outdated. I think it was maybe up until this point right here. But as you can see, the correlation is still alive and well. Important to keep in mind, because when you're trading USD JPY, what you're basically trading is the US 10-year. And I think keeping that in mind is important, because you may have different beliefs or thoughts about where the US 10-year is going, but somehow trade USD JPY like it's not nearly perfectly correlated. Okay, let's transition to SPY. Oh, I should probably get rid of these. I need to compare the US 10-year to this. Oops. Okay, so this is SPY right here. Let me actually switch over to the daily chart. We don't need to get the 4-hour.
And we say bye-bye.
So right now we're trading at about 41.34. the ES futures. And you can see we're in this pocket of potential supply. At least previously, this is where we had a strong impulse down. So potentially an area of distribution where you're going to see a lot of liquidity to the downside enter the market. Potentially. Obviously, we're not really seeing that yet. So I'm trying to remain nimble like the Fed. And we could see just some consolidation in here before another distribution that kind of mimics this one right here. We have some consolidation, and then we head lower. I am leaning more towards a continuation, bust through this liquidity. I mean, you probably got a lot of stops, retail stops on this side of these candle wicks or these wick highs. So I wouldn't be surprised if the market tries to inflict maximum pain, as it usually does, and continue higher up until this area, bust through this line of liquidity. Again, we got equal highs right here, so potentially a lot of liquidity left on this side that price would gravitate to, so it can get that sell side liquidity to eventually go down.
That's what she said.
Know what I mean? All right, and it also lines up pretty well with this area of supply. So again, we had another area of kind of consolidation that led to a large impulse down. So I would love, ideally, to see SPY, I mean, regardless of how long it takes, consolidates, whatever, eventually push above here into this region, ultimately for a selling opportunity, whether it gets just beyond these equal highs right around here, or pushes all the way to this area of supply, or even just fills in this imbalance right here. You can see this imbalance, this just wick to wick, pure selling candle. So anywhere in that region, and pretty clear stop just above this area right here. And then I would honestly probably just be targeting a new low all the way down here. And that gives you a pretty good risk reward, a little 4.5 risk reward, or 4R, 4.5R. But that's what I'd be looking at. Obviously, I'll remain flexible, and you'll want to see how price action develops. If it ends up pushing higher, or like I said earlier, if this ends up being the area of distribution before we head lower to that low, in which case, got to plan for all the possibilities, right? In which case, I would probably still try to get around these highs. Oftentimes, you see like a wick before price ultimately goes down. So something, maybe we consolidate, and then price just wicks up like this. So bust that high, and then come straight down. So it grabs liquidity before heading south. So I would probably look for an entry around that level. And hard to say where I'd put my stop. I guess just a little bit of breathing room. I don't know if I'd want it all the way up here. I'd probably just do a little tighter. And then again, also target the range low or a lower low. Because if we are headed lower, I think we're at the very least going to retest that previous low around, what was it, like 36, 37? That's 3,637. I'm not just counting.
Totally.
But yeah, so that's what I'd be looking at for SPY. And then I'll touch on NASDAQ, but they're so correlated that it's going to be mostly the same. But let's do it anyway. So as you can see, we have this similar kind of equal high situation. Similar area of supply, about the same distance away from those equal highs with liquidity. However, unlike SPY, that was lining up pretty well with what is basically, this is like the equivalent, the NASDAQ equivalent, where we had this area of distribution that led to the big impulse. We already pushed past it. So in my mind, that just hardens the case for price moving up towards this area to grab liquidity, maybe fill this imbalance right over here, and enter into this area of supply before ultimately heading down again to the range low. So pretty much the same thing as SPY, slightly different, but close enough. And again, just entry anywhere in this region. You really want to see how price is adapting. If we get some wick reactions to here, if we get a large impulse, if it looks like we're just going to pull liquidity by busting through these equal highs and then heading lower. But regardless of what it ends up being, this is roughly what I would be looking at. And again, about a 4-hour trade, so pretty decent. Okay, well, I'm just going to touch on crypto, and then we'll get out of here. Woo! So let's do it. All right, you can tell I was already talking about this a little bit. So here we have these ranges for Bitcoin. This from 32,600 to 25,500. And then this lower range where we got all the way down to 17.5. And the high of that range is roughly 24,600. And we are potentially headed to the top of that range. This could be, I mean, it looks like pretty mild price action. Could see a large impulse up here like I have drawn. And in that case, I would want to see, I mean, it could just end up being a wick where you just shoot up and shoot right back down. But I also wouldn't be surprised if we saw I mean, I'm not going to draw it again. It's right there.
You're a fucking idiot.
So price comes up here, consolidates a little bit. And again, as soon as that consolidation range is established, I would be looking for an entry at the top for price to run liquidity and then head down. So yeah, that's what I'm seeing. And I think just like with NASDAQ or SPY, I have a bearish short-term, medium-term outlook on Bitcoin and other risk assets. I think there's definitely still room to go, but eventually as liquidity dries up and the Fed continues to hike rates, honestly, all this kind of lives and dies with your inflation stance. Like if inflation is able to get squashed earlier, the Fed doesn't have to raise rates as much, and maybe risk assets get a bid. But I think that the Fed is going to be more serious about inflation. I mean, it's 9%. They've reiterated that they are serious about raising rates, and they're going to try to do something about it. So I'm just here to take them at their word and not fight the Fed in the sense that they are going to be withdrawing liquidity and making financial conditions tighter. So that, to me, doesn't spell good news for risk assets. And I personally, in the long term, don't think Bitcoin should be viewed as a risk asset, but it's how it trades, unfortunately. So you just have to accept it for what it is. You know what I'm saying?
Totally.
Okay, so yeah, that's basically what I'm looking at for Bitcoin. And like I said, could also just be a quick impulse, wick, or maybe we just go straight down from here.
That's what she said.
Who knows? Let's touch on Ethereum and then get out of here. Okay, so much like Bitcoin, obviously going to be largely correlated. Just how these markets are these days. So we have, now these ranges were a little bit more complicated because Ethereum had a pretty large downward move that left this no man's land range in between that it has since filled. So it's kind of like we have three ranges right now. So we broke out of this range right here, had a strong impulse up, and eventually touched all the way up to this previous range, which we have since retraced from. But I still think there is room to go up, just like with Bitcoin potentially. And I would be looking to probably this area right here. So in general, when you come back to a range, the heart of the meat of that range, the very center, is where most of the liquidity lies. I mean, that's just how middle of the ranges generally are. So I wouldn't be surprised if we saw Ethereum come back into the middle of this range, this previous range, around that 1950 level to draw liquidity and then head down. Now, I am not trying to make any projections just because Ethereum is notorious for ripping people's faces off in one way or the other. It just has a surprising like 17% day or 10% day in one direction. So definitely tread with caution.
Yep.
But in the meantime, this is what I would probably be looking at. I want to see a reaction to the zone, I'm not going to just short right off the bat. I want to see some type of reaction, maybe a pull liquidity, and then come back here. You have this high, you make a lower high, and then that would be my confirmation to maybe jump in as it starts heading lower around this level. And then I would write it down to the very least probably this range. I don't know. It's possible it goes all the way down here. But this would be target 1, and this would be target 2. And you could also include any of the midpoints of the ranges as targets. But in general, you want to view these things as ranges. because once price gets into a new range, the likelihood of it testing the range high or range low is very high. So right here, we broke out of this range, and we eventually traded to this top of the bottom of this range, but the top of what you can call this middle range. So if we were to show weakness here, even if we trade a little bit higher, actually, now that I'm thinking about it, this is the high. If we put in a short-term high that was lower than this and then started heading lower, I might be, and then especially if we broke below that level and then came back up, I'd probably be looking for a short in this region. Actually, let me just draw this with the order. Yeah, so stop above this high, invalidation level above this high, and then you would enter wherever this retracement might be. You could pick the actual range low right there. But what I'd want to be seeing is this price right now, like basically what we're seeing. It's got this green candle developing right now, and see a lower high form, lower relative to this level right here, and then come back down. And I would love to see a break of this, a break of structure, form a lower low, and then a pullback where I could hopefully load up onto a short anywhere in this region. Really depends. Probably try to line it up with any potential supply in this area, a supply zone, and then again write it down to at least this range low, if not this one. All right, well, I think that's all I have for you today. Aww. But as always, oh wait, real quick, I forgot, totally forgot. I have a special meme I wanted to end things off with that I foreshadowed in the beginning. So this is basically where we're at right now. I was kind of talking about the recessionista, inflationista debate, and here we have depression and inflation making whatever the fuck this Fed policy is. So this is a good visual of what the Fed is kind of dealing with right now. But with that, I will sign off. So as always, stay happy, humble, and hopefully in the money. And I'll catch you all next week.